The global economic landscape is once again gripped by a palpable tension as the looming July 9 deadline for the expiration of President Trump's tariff pause sends ripples of uncertainty across international markets. This week has seen a flurry of activity and conflicting signals painting a complex picture of ongoing trade negotiations, corporate recalibrations, and even whispers of significant internal political shifts within one of the world's major economic powers. The high-stakes game of tariffs once again dominates the discourse, with repercussions extending from multinational boardrooms to the average consumer's wallet. At the epicenter of this economic tempest is President Trump's assertive stance on trade. This week he reiterated his intent to send letters to trading partners within a week and a half, 2 weeks, unilaterally setting tariff rates, a move he characterized as a take-it-or-leave-it proposition. This declaration, made at the Kennedy Center, adds further ambiguity to an already volatile situation, especially as the July 9 deadline for his most punishing duties approaches. Curiously, Treasury Secretary Scott Bessent offered a diverging view to Congress, suggesting that a tariff pause extension is highly likely for countries negotiating in good faith. This divergence underscores the fluid and often unpredictable nature of the administration's trade policy. The most significant development on the trade front this week involves China, with whom the U.S. has reportedly reached a framework and implementation plan to ease tensions. President Trump himself proclaimed the deal done pending final sign-off from him and Chinese President Xi Jinping. This agreement, following earlier talks in Geneva, is said to address critical issues like rare earth mineral exports and Chinese student visas to U.S. colleges, both recent sticking points. However, the details remain opaque, with a Reuters report indicating China would only loosen rare earth restrictions for a 6-month period, potentially retaining leverage. Commerce Secretary Howard Lutnick, while stating "you can definitely say that current tariff levels on Chinese imports won't change again," also highlighted that the 55% tariff figure Trump cited is an aggregation of existing duties, not new levies. Despite the apparent truce, market observers like AGF Investments' Greg Valliere noted that the deal might lack meat on the bones, suggesting it primarily prevents relations from worsening rather than signaling a comprehensive resolution. The reverberations of these tariff policies are being felt globally. Corporate giants are actively adapting, as evidenced by an exclusive Reuters report revealing that nearly all iPhones exported by Foxconn from India between March and May went to the U.S., a significant jump from the usual 50% average. This highlights Apple's concerted effort to bypass Trump's tariffs on China-sourced goods. RH Restoration Hardware CEO Gary Friedman provided a candid account of navigating a chaotic and unpredictable quarter. He described how Trump's initial Liberation Day announcement, which briefly hiked tariffs on China to over 100%, rattled the supply chain, causing companies to halt shipments and production. While RH expects a 6-point negative impact on Q2 revenues, it projects recovery in the second half, partly by shifting sourcing out of China, aiming for 52% of upholstered furniture to be US-made and 21% from Italy by year-end. Friedman also noted that larger players like RH might gain market share as smaller, less flexible competitors struggle or go bankrupt. Beyond individual companies, entire economies are feeling the pinch. Canada's factory and wholesale sales fell in April due to U.S. tariffs, while the U.S. tourism industry warns that foreign visitors are choosing alternative destinations. Japan's economy is particularly vulnerable, with its trade negotiator hoping for an exemption from potential auto tariffs and a former Bank of Japan policymaker suggesting that U.S. tariffs may have ended the BOJ's rate hike cycle. Conversely, the EU's goods trade surplus with the US expanded in April despite tariffs, showcasing varied impacts. NVIDIA's CEO Jensen Huang disclosed that US chip curbs have forced the company to exclude China from its revenue and profit forecasts, illustrating the direct hit to the tech sector. Economically, the tariffs have yielded a surprising outcome for US government coffers. New tariffs on steel, autos, and the broader 10% tariffs introduced this year brought in over $22 billion in May alone, with total collections from Trump's duties reaching $92 billion since January 1. The Yale Budget Lab estimates the overall effective U.S. tariff rate at 15.6%, the highest since 1937. This revenue stream is so substantial that the Congressional Budget Office suggests it could potentially offset a significant portion of the proposed $2.4 trillion deficit from the president's signature tax and spending bill. Meanwhile, J.P. Morgan Chase CEO Jamie Dimon offered a cautiously optimistic view, suggesting tariffs might make the soft landing a little bit softer as opposed to the ship go down, though he anticipates rising inflation and slightly lower employment. Citi's global investment bank clients are evaluating a baseline tariff level of 10 to 20%, indicative of the new normal. Compounding the external pressures on China are growing internal political questions surrounding President Xi Jinping. Whispers and subtle signs amplified by China watchers suggest a potential weakening of his authority. The recent omission of his late father Xi Jinping, a revered CCP veteran, from official narratives and a planned memorial hall, along with the abrupt cancellation of a state-produced drama about his life, are seen as significant indicators in China's opaque political landscape. Xi's unusual two-week disappearance from public view in May further fueled speculation. Analysts observe a shift in state media from praising Xi as the eternal core to emphasizing collective leadership, and note that academics critical of his policies have not been punished. Reports of military purges, including the arrest of CMC Vice Chairman He Weidong and the dismissal of Admiral Miao Hua, both members of Xi's Fuzhou faction, point to potential challenges within the armed forces. Economically, discontent over Xi's stringent COVID-19 handling, a struggling property market, rising graduate unemployment, and a collapse in foreign direct investment (FDI) reaching a 30-year low in 2023 are contributing to a pervasive sense of malaise. Many attribute the FDI decline to Xi's wolf warrior diplomacy. Some long-standing China watchers like Willy Wolaplam and Kai Shinkun speculate that Xi's ability to shape policy has been truncated, with some even suggesting a graceful withdrawal from the political stage might be arranged. While Xi's reappearance on June 4 for a meeting with Belarus leader Alexander Lukashenko was noted, its unusually subdued nature and lack of Chinese press presence did little to quell the rumors. Further underscoring the complexities of regional dynamics, a Taiwanese court sentenced a Chinese captain for intentionally damaging undersea cables, highlighting vulnerabilities in critical infrastructure. Simultaneously, Chinese President Xi Jinping held a rare public meeting with the Panchen Lama, a move widely interpreted as an attempt to assert control over the succession of the Dalai Lama, particularly as the latter approaches his 90th birthday. This aligns with Beijing's ongoing Sinicization campaign, seeking to align religious practices with the Communist Party's vision. As the July 9 deadline approaches, the global stage remains a chessboard of intricate moves. The U.S. continues to wield tariffs as a primary tool, generating significant revenue but also provoking widespread economic adjustments and retaliatory measures. China, while seemingly agreeing to a trade framework, appears to be leveraging its strategic assets like rare earths, all while navigating internal political currents that could reshape its leadership. The intertwined narratives of trade, geopolitics, and domestic power struggles suggest that the coming weeks will be critical, potentially ushering in a new phase of global economic and political realignment, with consequences that will resonate far beyond the immediate deadlines. The global economy stands on the precipice of renewed trade volatility as the July 9 deadline for President Trump's sweeping tariff pause rapidly approaches. This week, the president himself injected further uncertainty, telling reporters that he intends to send letters to trading partners in the next week or two, setting unilateral tariff rates, a move that could profoundly reshape international commerce. This direct threat, coming soon after the introduction of steep new duties that roiled markets, casts a long shadow over the temporary reprieve and has markets bracing for potential Liberation Day 2.0 scenarios. These developments unfold against a backdrop of complex, often contradictory signals from Washington and Beijing. Earlier in the week, Treasury Secretary Scott Bessent told Congress it was highly likely the tariff pause would be extended for countries negotiating in good faith. Indeed, The US and China recently announced a framework and implementation plan aimed at easing trade tensions, a breakthrough that followed intense marathon talks in London and built upon a fragile truce established in Geneva last month. President Trump hailed the deal as done pending final sign-off from himself and Chinese President Xi Jinping, and indicated that it would resolve issues around rare earth mineral exports and allow Chinese students in U.S. colleges, a sticking point that emerged post-Geneva. However, reports quickly surfaced, notably from the Wall Street Journal, that China's easing of rare earth export curbs would be limited to a 6-month period. A detail Trump did not initially mention, highlighting China's strategic leverage in a sector vital for high-tech goods. From electric vehicles to jet fighters, the chips versus rare earths dynamic has become a central battleground in this evolving economic conflict. While the U.S. sought to maintain its tight export controls on advanced semiconductors, China's demonstrated ability to develop workarounds such as DeepSeek's AI platform suggests its resilience. As Commerce Secretary Howard Lutnick stated, "You can definitely say current U.S. tariff levels on Chinese imports won't change again," though he touted U.S. gains in access to rare earths and magnets. President Trump, for his part, claimed the U.S. would receive a total of 55% tariffs on Chinese goods, a figure White House officials clarified as an aggregation of pre-existing duties rather than new impositions. This intricate dance of negotiation, concession, and assertion underscores a fundamental shift in the trade war's focus, moving beyond mere trade imbalances to a deeper struggle for control over global supply chains, as noted by the World Socialist website. The broader global economic landscape continues to bear the brunt of these trade tensions. The World Bank recently slashed its global growth forecast for 2025 by 0.4 percentage points to 2.3%, citing high tariffs and uncertainty as a significant headwind. Domestically, the U.S. Treasury has seen soaring government revenue from tariffs, collecting over $22 billion in May alone and $92 billion since January 1, potentially offsetting costs of the administration's tax and spending bill. The Yale Budget Lab estimates the overall effective U.S. tariff rate at 15.6%, the highest since 1937. However, the economic picture is mixed. May's Consumer Price Index (CPI) report showed inflation pressures easing slightly on a monthly basis despite concerns tariffs would accelerate price increases. Corporate America and international partners are grappling with the ripple effects. Foxconn, a key Apple supplier, has drastically shifted its iPhone exports from India to the U.S., with nearly all shipments between March and May going stateside well above the usual 50% average, in a clear effort to bypass Trump's tariffs on China. NVIDIA's CEO Jensen Huang explicitly stated that U.S. chip curbs on China have forced the company to exclude the Chinese market from its revenue and profit forecasts. RH CEO Gary Friedman vividly recounted navigating a chaotic and unpredictable quarter, with reciprocal tariff announcements rattling supply chains and causing production halts. Despite the turbulence, RH reported an unexpected Q1 profit, partly by shifting sourcing out of China and benefiting as smaller, less resilient competitors faced bankruptcies. Meanwhile, Zara owner Inditex reported disappointing early summer sales impacted by tariffs. Internationally, the effects are palpable. Canada's trade-focused industries are slowing, with factory and wholesale sales falling in April. Britain's goods exports to the U.S. saw their largest monthly drop since 1997. Even as the EU's goods trade surplus with the U.S. grew in April despite tariffs, other nations are actively seeking to mitigate the impact. The UK is ready to implement a trade pact with the US to reduce tariffs on auto and steel imports, while the US lowers duties on British beef and ethanol. US and Indian trade officials have hardened their stances on key issues as they work towards a bilateral deal before July 9, with the US pushing for market access for genetically modified crops and medical devices, and India seeking exemptions from reciprocal and sectoral tariffs. Japan too is hopeful for a deal to prevent higher auto tariffs, a sector critical to its economy. As the July 9 deadline looms, the future of global trade remains shrouded in uncertainty. While some like JP Morgan Chase CEO Jamie Dimon cautiously suggest tariffs might make a soft landing a little bit softer rather than causing a significant downturn, the consensus among many analysts points to continued disruption. The Federal Appeals Court's decision to allow Trump's sweeping tariffs to temporarily remain in effect, overturning a lower court's unlawful ruling, provides the administration with legal backing, at least for now. The ongoing negotiations, the threat of unilateral action, and the strategic maneuvering over critical resources underscore that the trade war is far from over. Instead, it appears to be entering a new, potentially more volatile phase where the control of economic levers and supply chains will define the next chapter of international relations. The global geopolitical landscape continues to shift dramatically, with recent developments highlighting both a fragile de-escalation in the protracted US-China trade dispute and a dangerous escalation in the Middle East, where the two superpowers find themselves on opposing sides. These concurrent events underscore the complex, interconnected challenges facing international diplomacy as major powers navigate economic competition alongside regional conflicts. Just days ago, U.S. President Donald Trump declared a U.S.-China trade deal done, signaling a significant step towards de-escalating tensions that have roiled global markets for years. The announcement, made on his Truth Social platform on Wednesday, followed 2 days of intense negotiations in London. According to Trump, the agreement, subject to final approval from himself and Chinese President Xi Jinping, stipulates that China will supply full magnets and any necessary rare earths up front, while the U.S. will reciprocate by allowing Chinese students access to its colleges and universities. Trump also detailed the tariff structure, stating the U.S. would retain a total of 55% in tariffs on Chinese imports, while China would maintain 10% on U.S. goods. This 55% U.S. tariff, a White House official clarified, is a composite of a baseline 10% reciprocal tariff, an additional 20% due to punitive measures related to fentanyl accusations, and pre-existing 25% levies from Trump's first term. The London talks, described by U.S. Commerce Secretary Howard Lutnick as putting meat on the bones of a preliminary Geneva agreement aimed to get a fragile trade truce back on track. That Geneva deal had faltered over China's continued restrictions on critical mineral exports, which prompted the Trump administration to impose new export controls on semiconductor design software and other goods to China. Lutnick confirmed that the London framework would remove restrictions on Chinese rare earth minerals and magnets, along with some recent U.S. export controls, in a balanced way. China's Vice Commerce Minister Li Changgang echoed this sentiment, confirming a framework had been reached in principle. While seen as a step forward, the specifics for implementation remain unclear, and the deal does little to resolve underlying differences or the August 10 deadline for a more comprehensive agreement, beyond which tariffs could snap back to crushing levels. Josh Lipsky, senior director of the Atlantic Council's Geoeconomics Center, aptly summarized the situation, stating they are back to square one. But that's much better than square zero. The World Bank recently slashed its global growth forecast for 2025 by 0.4 of a percentage point to 2.3%, attributing this downturn partly to higher tariffs and heightened uncertainty, a context that makes any trade de-escalation a welcome if tenuous development. However, even as trade tensions show signs of easing, a volatile situation in the Middle East presents a stark contrast, revealing deep divisions between Washington and Beijing. Israel recently launched Operation Rising Lion, a large-scale assault targeting Iran's nuclear and missile infrastructure, with explosions reported in Tehran. While the U.S. quickly lauded these strikes as excellent, China vehemently condemned them as military adventurism. This divergence highlights a critical fault line in international relations. Foreign policy analysts are now assessing the fallout, with some suggesting China may be the conflict's biggest geopolitical loser. Gordon Chang, a senior fellow at the Gatestone Institute, commented on Fox Business Network's Varney & Co., stating that Iran being set back on its heels by Israel means nothing is off the table for China and its military advances. Chang elaborated that Iran has long served as a proxy for China's foreign policy goals in the Middle East, and with Iran facing setbacks, China's Middle East policy is now in disarray. China's support for Iran has been extensive, including purchasing over 90% of Iran's crude oil exports and providing weapons. Chang noted that Chinese-made arms are widespread among Iran-backed militias such as Hamas, Houthi and Hezbollah, with Iranian weapons themselves often incorporating Chinese computer chips. His stark warning suggests that China, suffering a terrible loss in the region, is not going to take that lying down. And it's probably going to get Iran or some other party to strike us. Amidst this escalating crisis, U.S. President Donald Trump also weighed in via Truth Social, warning that Israel's next round of strikes could be even more brutal if Iran does not return to the negotiating table. Beijing, for its part, has attempted to portray a more balanced diplomatic stance, with China's foreign minister speaking to both Israeli and Iranian counterparts, affirming support for Tehran while expressing readiness to play a constructive role. The coming months will be critical. The implementation of the U.S.-China trade framework, particularly the specifics yet to be detailed, will determine if the fragile truce holds or if tariffs snap back to previous levels, further unsettling global commerce. Concurrently, the Middle East remains a powder keg, with the potential for regional escalation and proxy conflicts that could draw in global powers. How China adapts its Middle East strategy in the wake of the recent Israeli strikes, and whether its diplomatic overtures can temper its condemnation of Israel, will be closely watched. The delicate balance between economic cooperation and geopolitical competition will define the trajectory of superpower relations, demanding astute diplomacy and a clear-eyed understanding of rapidly evolving global dynamics.